Welcome back again to the Money Master Unleashed podcast. This is your host, Adam Olson, with you today. And today's going to be one of the favorite episodes that I'm going to be doing with you guys today. It's about retirement income planning for self-employed people and some tax strategies for self-employed people. You see, as an entrepreneur, maybe a solopreneur, maybe you have a large business that you're running, you really have a lot of unique challenges and strategies that you're dealing with day in and day out. And personally, as a business owner myself, I love learning about these things and I love educating people about them because using some of these strategies that I'm going to be talking to you about today, I can have a huge impact not only in your life, but your family's life, but for potentially generations to come. So let's dig into this a little bit more here. I've been a certified financial planner with Mutual of Omaha for over a decade, and the information that I've learned from being a business owner and from educating myself with the designations that I have really put me in a unique spot to help you as a self-employed individual or a business owner create the best financial life for yourself today using some of these retirement income strategies and some tax strategies, but also help set your family up for generations to come. So let's really talk first about retirement planning for self-employed individuals. You see, I see far too many business owners have their entire lives wrapped up in just their business. Now, I always believe in betting on yourself first, and I always think the best rate of return that you're going to get from an investment standpoint is betting on you by yourself. But it's always a good idea to diversify into other areas as well. So just say you're a construction company. Say you own a construction company and your entire life is wrapped up in that construction company. Well, if we have a big financial downturn or people stop building or people stop remodeling because rates are high, it could really affect your income. And if you're selling into that potential recession, it can also affect the sale of your business. So if I could have caught that potential, say, 6-year-old construction business owner when they were 30 or 40, we could have implemented a lot of these strategies that I'm going to educate you on today to help them maybe weather this storm or delay that sale until the market recovers. You see, we can use tax strategies today and retirement plan strategies today to even lower that tax bill, not only today, but potentially in the future as well. So being proactive with your income planning for retirement, we can design a plan for you today that will really help alleviate a lot of these potential problems that you can face down the road. So some things that I like to do for self-employed people, first and foremost, is set up retirement plans. So we can set up a 401k, we can set up a simple IRA, or we can set up a SEP. Essentially, these are ways for you to invest dollars, whether it's on a pre-tax basis to lower your taxes today, or on a post-tax basis to give you tax-free income in the future. We can utilize these accounts to help get you money outside of the business that you can use for either income in retirement or maybe potential sales of the business or maybe potential buying other businesses in your later years. Say after 60, if you want to access some of those funds, you can certainly utilize them for those things as well. So having some money outside of the business is a good idea, I think, because it gives you diversification into outside markets, and it also gives you freedom and flexibility of withdrawals in your later years. In addition to that, if it's a family-operated business, saving outside of that company is really going to allow you some flexibility when it comes to distribution time, that you're not forced to get a quick sale of the business to get money from family members. You can maybe give them a more favorable deal that's longer term in length. So if you're a business owner, first and foremost, you need to be thinking about what type of retirement accounts can I set up to either get a tax deduction today or potentially tax-free income in the future. And again, I think it's a great idea to have business assets that are held outside of the business. Retirement planning assets outside of the business give you a lot of flexibility down the road. In addition to that, I always like thinking about setting up a certain percentage that we're going to do into these things each and every year. So if I'm a business owner, say my income is just $100,000 per year. Think about siphoning off maybe 10, 15, 20% into things going on outside of the business. Again, this could be retirement plans that you're setting up. This could be maybe rental real estate that you're setting up. This could be maybe investments in other businesses that you're setting up. But doing something outside of the business just gives you some diversification. In addition to that, if you're a business owner and your family works inside of the business, say your kids are working inside of the business, as long as your kids are of a certain age and they're actually doing work inside of the business, you can legally pay those kids each and every year. What's really cool about that is if you keep the income to your children under a certain threshold, they get that money income tax free and it's a deduction for the business. On top of that, a unique strategy that I put in place for a lot of clients is taking that income that the kids get and putting it into a Roth IRA. Remember, the Roth IRA grows income tax-free and distributions are tax-free in the future. That is an excellent strategy that you can be looking at if your kids are employed inside of your business. On top of that, as a business owner, you really need to think about what other tax advantages can you take advantage of. Not only the retirement plan tax benefits, maybe paying your kids tax benefits, but you also need to look into the Augusta Rule. So you can actually rent out your personal residence for less than 14 days per year, and that can be a tax benefit from you. You're paying rent to yourself as an individual, tax-free income as an individual, and deductions from a business standpoint. Now, when you're utilizing this strategy, you need to make sure that we're having a board meeting or a corporate retreat, or using the home residence for really something business related on that day, and make sure it's a reasonable price that you're paying yourself. That can be another strategy that you can implement to get tax-free money to yourself from the business. And then really on top of this, I want to dig into a couple other things into this video today. We need to have some really clear goals about what we're trying to accomplish, and that we need to do things on a regular basis, okay? So really, when we're talking about these goals and these strategies, I have 3 accounts that I love self-employed people to look at. I like to look at pre-tax accounts, which helps keeps our income down today. So if we have a really, really high income year from a business standpoint, maybe we want to implement a pre-tax strategy to keep our income down. I always like talking about post-tax strategies too. That's usually utilizing things like Roth IRAs and maybe life insurance as well, where we can get money to grow and potentially get tax-free distributions in the future. So we have some post-tax things that we talk about as well. And on top of that, I like looking at taxable accounts as well. What's really cool about taxable accounts is we can access that money really whenever we want. So with pre-tax accounts, with Roth accounts, you have some stipulations on when and how you can take out from them. But if we're using taxable accounts for some investment strategies, we can access that money at any time. Now, there is tax consequences, obviously, with these type of accounts, but there's no specific ages where you have to wait to access the money. So let's dig into this a little bit more. Well, how do you weigh the differences between what type of these investments are we going to use year over year? Well, again, I say you have a high income year as a self-employed individual, use pre-tax accounts to keep that income down. So if you have a middle of the road income year, I would highly encourage you to suggest using some of these Roth strategies. In addition to that, I love regular contributions to that taxable account, just so we have some liquidity built in so you can access funds when you want and how you want. Again, I always think you're best off betting on yourself as a business owner, but using some of these other strategies outside of the business can help you diversify your portfolio and diversify your holdings. That way, if you need to access money sooner, later, or potentially on a tax advantage basis, you've already done the work in your 30s and 40s to have those accounts set up so you can use. The next thing that you need to really consider as a self-employed individual is using HSA accounts. This is one of the furthest and most overlooked accounts that people don't take advantage of. HSA accounts are triple tax benefit. That means that money goes in income tax free, and as long as you take it out for the right things, it comes out income tax free. And along the way as it grows, there's no income taxes due as well. So you have to have a high deductible health plan to contribute to an HSA. So what I do and what I think you guys should be doing too as business owners is get a high deductible health plan, fund your HSA each and every year. And you should have the cash flow available to you today as a business owner to pay for these healthcare costs that you have. What that allows you to do is take those HSA dollars and place them inside of an investment account. In that investment account, we're going to get these HSA dollars to grow over time. And ideally, we wait till your retirement ages to start accessing these funds. Why? Well, why we wait till you're age 65 or older is your HSA dollars can be used to pay for Medicare premiums. That'll start for you as a self-employed individual probably when you're 65. We can use it to pay for long-term care costs, long-term care insurance premiums, and obviously any health insurance expenses, healthcare costs that you have at retirement time, we can use those HSA dollars for as well. And that's an extremely powerful tool to take care of pre-tax contributions, growth that's tax-free, distributions that are tax-free. If you can do that for a meaningful number of years, say 10, 15, 20 years, I think you'll really like how that HSA balance works. In addition to that, on top of this, we really need to take a hard look at Social Security planning, not only for you, but your spouse. So if you have a sole proprietor business, are you or are you not employing your spouse inside of the business? That's a really important strategy for you to look at year in and year out. Not only from a Social Security income standpoint, but also from a Social Security disability planning standpoint as well. You see, to take full advantage of Social Security and the benefits it offers, you have to have a minimum number of work credits to be eligible for Social Security. So I would encourage you to work with your financial advisor and your CPA to make sure that you have the proper income each and every year to qualify for your Social Security benefit, not only for you at retirement time, but also currently from a disability standpoint as well. That is an overlooked strategy that a lot of people don't take advantage of. So in closing, I just want to recap a couple things with you guys. As a business owner, I think you're always best investment option is to bet on yourself. Bet on yourself first and foremost, always. But outside of that, I think you should be looking at what other investment options can I be taken advantage of. There's the 401k, where you can defer pre-tax and post-tax. There's a solo K that you can look at if you're a sole proprietor, which has some really cool, unique benefits to it as well. You can look at a SEP IRA or a simple IRA. These are all retirement income strategies that you can use to save for your future retirement. And on top of that, if you're a business owner, should you be paying your kids? If they're under a certain age, if they're over a certain age, you can actually pay your kids. So ideally, you want your kids to be over the age of 7. And if they're still working in the business at that age, make sure they're doing things that you can actually track and keep record of. You can pay them a wage if it's under a certain amount, a little over $14,000 this year. They can get that income tax free. Use that money to fund a Roth for the kids, and they are well on their way to becoming financially set for the rest of their life. On top of that, I talked about the Augusta Rule, where you can rent out your primary residence. And don't forget to take advantage of HSA accounts as well. Now, when we're investing outside of the workplace plans, pre-tax and post-tax, you can look at taxable investment accounts. These are some of the accounts that are liquid, and so you can access money as needed in and out based upon your business's cash flow needs. So what are some common mistakes that you need to avoid? Some common mistakes, again, that you need to avoid is having everything wrapped up into one business, one thing. Because if you try to sell that business during a downturn, you might not get what you want. Or if you're trying to sell it to a family member, you may put them in a disadvantaged situation because you don't have other outside income sources that you can utilize. And another common mistake, make sure you're taking advantage of the Social Security benefits that are available to you. Work with your advisor and your CPA on those strategies. And really, this is a year-over-year decision that you need to be making on what type of accounts you're going to be funding, when you're going to be funding them, and how you're going to be funding them based upon the cash flow or income from your business in that specific year. So I would encourage you, invest in yourself first and foremost. But don't forget to look about other outside investment accounts that you can be utilizing as a business owner to increase your diversification inside of your overall financial plan and your financial strategy. So I hope you guys enjoyed this episode today on the Money Master Unleashed podcast, talking about self-employed individuals and what they can use to save for their future and save on some taxes today. So if you enjoyed this episode, I would encourage you to subscribe. And if you found value, leave me a comment and let me know. If you think somebody would enjoy this, share it out with them. It would mean the world to me. My website is adamolson.biz if you want to connect with me. And I look forward to seeing you next time here on the Money Master Unleashed podcast. Thanks for listening. This podcast is for educational purposes only and may include references to concepts that have legal and or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59 and a half, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.